Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative, and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
Good day and welcome to the Corton Enhanced Income Fund ETF webinar. My name is Keith Pangretitcsh, and I'll be hosting today's call. Prior to working with Corton, I spent many years at a large global financial institution. And when I was there, one of the things that I recognized, or one of the things I experienced, was falling interest rates. And so that was really one of the main drivers of launching this ETF. As interest rates over the span of my career went from short-term interest rates of close to 20 all the way down to zero, no one had to really worry about bonds because interest rates fell all the time, and you made money on the yield, and then you also made money in capital gains because as interest rates went down, there was gains to be made there. Unfortunately, or in 2020, and when COVID came around, interest rates went below zero, and now we do have to worry about duration. I'll give maybe a little quick story, two quick stories to highlight that point, because I think one of the main things, main risks that we underappreciate in fixed income is duration. And so the first story might be one that comes back from 2020. And that was when the Austrian government, and there was other governments did it, issued a 100-year bond. And at that time, the interest rate or the yield on that bond was right around 1%. It was actually about 80 basis points. And you would think that, if you invested in the sovereign bond, such as the issued by the government of Austria, you wouldn't lose money. And in fact, you won't. But as you can imagine, as interest rates have gone up, that bond today is trading at about 40 cents on the dollar. So you've lost more than half of your capital or principal. Now, if you hold that bond to maturity, you will get your money back plus interest. But at the current date, that's 95 years from now, if interest rates stay at the current yield. The other story I'll give, so risks of duration, the other story I will give is I always ask investors, what's the least risky security that you can invest in? And most people come up with the right answer. And that answer is U.S. Treasuries. You can't go wrong with investing in the U.S. government. And I would say that's correct. But that investing in the U.S. government is great. But all of a sudden, if you put a 30-year duration on that bond, they become extremely risky. And, recently that's what took down, if anybody remembers, Silicon Valley Bank and Signature Bank. They were investing in 30-year U.S. Treasuries. And when interest rates went the wrong way, it took those banks down. So once again, you can invest in a very high quality entity like the government of Austria or the U.S. government. But if you tie duration to that, it becomes automatically pretty risky. Now, most investors aren't going to invest in a 30-year bond or a 100-year bond, but they're going to invest in some shorter duration, like a 6, 7, 8-year bond. We think that a better solution is to actually invest in credit and avoid investing in fixed rate yield. Now, when I say that in the context of most people today in Canada, their bond portfolio is probably 90% or more fixed rate. So you can still invest in fixed rate. We're just making a case, and our products that we have invest in floating rate. And we think that that is more aligned with the goals that people have around fixed income. So the one product that I'm going to talk about today is the Corton Enhanced Income Fund. The ticker on that is our AAA. And what this really is to an alternative to is short-term cash products like a high-interest savings account or an ultra-short government bond. And why we think it's a reasonable replacement and even better is for three reasons. One, we will show you that you can actually achieve higher yields with the Corton Enhanced Income Fund. You can still maintain a high quality, actually even a higher quality for the given level of yield. And we think it's a great complement to existing portfolios. Once again, the majority of portfolios are fixed rate. This is floating rate. And it has a low correlation to equities. So let's kind of go through these top three things. First one is cash replacement, higher yields. So what I did here is just very simply, one of the most popular products in the last couple of years has been high interest savings accounts. Now, those high interest savings accounts, when they really became ultra popular, the banks came in and chopped the interest rate a little bit because they were getting too popular. By about 50 basis points, it dropped the yield. And so what we've been able to do is within the Corton Enhanced Income Fund, we're using AAA CLOs or collateralized loan obligations. And you can see over the last year, we'll talk about the credit quality, but you can see over the last year, we've added anywhere from over 100 or about 140 basis points to about 77 basis points vis-a-vis these products. So, and we think that that's actually going to continue. If we look at the long-term averages of AAA, single A, double A, CLOs relative to corporate bonds, there's a pretty substantial spread that does occur. And once again, this is over the long term. You can see the average one-year spread on AAAs have been 92, double A's 170, and over 200 basis points on a single A. Now, we wouldn't compare a single A strategy to a high interest savings account, but we'd certainly compare a AAA strategy to high interest savings accounts. Net on our portfolio, we're always going to maintain an average credit rating of AAA. So minimum that we have to have in this product is 60% in AAAs, and we can have a maximum of 40% in single A. And when you look at that model, you'll see that over long term, and the graph on the left part of this slide shows that, is on average you get about 132 basis points pickup gross vis-a-vis a high interest savings account. And we think, once again, for the level of risk, we think that's a great trade-off. The other thing I would note that today, you're really not getting compensated to a great degree for the level of risk you're taking. Spreads on corporate bonds are at all-time lows. You can see here just on AAA, currently sitting around 33 basis points. The long-term average is 56, and the max spread that we've seen is 2.35%. So we think that if you're not getting compensated for the risk you're taking in corporate bonds, it's time to look elsewhere. What we categorize these are really asset backed. So instead of within corporate bonds, majority of those corporate bonds are backed by the willingness of the corporation to pay. There's no physical assets behind it. What we're investing in does have physical buildings, plant, equipment, and other assets that are backing it. So that's how they get their AAA rating. So first part of this story is we think we can achieve a higher yield, and the long-term statistics point to that. It's about 130 basis points of pickup, 100, 135. We think that's great. So your running yield, instead of right now, the HISA rates are paying, or the high interest savings rates are around 2.5%. You can get closer to 3.9, even 4% on a AAA CLO portfolio. So that's the yield side of things. The next thing I want to talk about is the credit rating. And, you know, people can have different views on credit ratings. Once again, here's just a couple quotes that I pulled from the internet. What is AAA and how do you get AAA? Well, AAA is actually, as you can probably assume, the highest credit rating you can get. Now, who actually holds a AAA credit rating? And how hard is it to get? Well, as you can see, as of 2025, the United States government no longer holds a AAA credit rating. That was downgraded by Moody's in May of 2025. The number of countries with those sovereign countries with AAA credit ratings has shrunk from about 60 to now 11 globally. And no US or Canadian financial institution holds a AAA credit rating. Now, how can the investments that we're buying get a AAA rating? And there's a couple reasons. One is through diversification. The CLOs that we own, there is generally no single component of that is going to be over 1.5% of the portfolio, so there's broad diversification. Number two, all the securities that we own are backed by hard assets, as I said earlier. So buildings, plant, equipment, hard assets that are easily tradable, or maybe not so easily tradable, but they have a value attached to them. And then the number three reason is the CLOs have different risk levels to them. So even within the CLO, every CLO has a AAA tranche, which is supported by the AA tranche, which is supported by the single A tranche, and so on and so forth. So if something does go wrong, there is a lot of subordination, if you will, below the AAA level, that if there's any delinquencies or is there any failures, those are soaked up by the equity tranche and the tranches, the BBB tranche, the BB tranche, and so on and so forth. So maybe a little bit technical, but you can have 50% of the portfolio go into default. And if the average recovery rate on that is around 70, 80%, but even if you had 50%, 50% of the portfolio goes into default with 50% recovery, there would be zero impact at the AAA level. So that's what we call subordination, and that's one of the supporting aspects of how these securities get AAA credit rating. So number one, we're going to get a higher yield. Number two, actually going to have a better credit rating than a high interest savings account or a corporate bond fund. So you can see here, I just kind of pull up some ETFs in this space, and you can look at the credit quality. Our AAA has 60% of the portfolio, 60.8 in AAA, 39.2% in single A. That exceeds anything, and these are the highest rated or some of the highest rated ETFs that would be comparable from a cash replacement perspective. Now, for Canadian investors, CLOs might sound a little exotic. They're really not. They work like any other balance sheet, but certainly there have been some issues in other structured credit assets. But if you look at this chart, which shows the cumulative loss ratio on CLOs versus things like residential mortgage-backed securities that ran into trouble in 08, or even commercial mortgage-backed securities or other structured finance products, CLOs actually had, at the AAA level, have never, ever experienced a default. And even at the triple B level, very limited defaults. So once again, these securities have gone through the test of time and held up extremely well, reinforcing their AAA rating for investors. Now, for some of those that are unfamiliar with CLOs, it's a $1.2 trillion market. In Europe, where we largely invest, The AAA level is 160 billion. Lots of liquidity here, lots of supply for our product. The entire European CLO market is over 260 billion. We can go into both European and US. As it stands right now, we like the European market. We think it offers a little bit more extra value and security for our investors. So once again, we think that this is a great alternative to more traditional cash alternatives in Canada, whether it be a short-term bond fund or a high-interest savings account ETF. Some people think that high-interest savings accounts are protected, insured. They are not. The ETFs are not. Our products, we think, are once again also not insured, but they're backed by those hard assets and that AAA credit rating. So we think we like the yield enhancement at 130 basis points on a long-term average. We think that more than enough compensates for any additional risk that we're taking with a AAA CLO, and we don't think there's much. For products that we see in the US market that have been around for a lot longer, standard deviation is less than 2%. If you're under 6% standard deviation, that's considered low risk, and this is trading below 2%. We like the high quality assets. Once again, we're at all times going to have an average credit rating of the ETF of AAA or higher. I guess the question is, why do we get this added enhancement? Well, it's really more of an institutional market, larger sizes to access this market, and therefore a little bit better terms, which is one of the reasons why we see that yield enhancement. So a little bit about the terms. Once again, I told you the ticker is RAAA. It's traded in Canadian dollars on the Toronto Stock Exchange. The yield is close to 4% as we speak, and we think it's a tremendous option for any investor that's looking to park some money, or for the short term, or to have a longer term floating rate asset class that's going to give them a adequate yield for the level of risk that you're taking. If you have any questions with respect to the fund, you can certainly go on to the Corton website at cortoncapital.ca, or you can contact us at Corton Capital Inc. in Toronto. Thank you very much for your time.